Can you retire using a retirement bank? Can you really take your hard-earned nest egg, pull it out of the volatile stock market, dump it into a standard bank retirement account, and expect to live comfortably for the next 20, 30, or 40 years? That is the question so many of you who are approaching retirement or are already retired are asking me right now. You are terrified. You look at the stock market, you look at the news, and your stomach turns. You think to yourself, Susie, I cannot take another market crash. I cannot watch my life savings disappear overnight. I just want my money to be safe. So you see an advertisement from a local bank or a big financial institution offering a retirement bank account or an IRA filled with certificates of deposit, and you think that is the answer to all your prayers. You think it's the ultimate safe haven. Well, I am here today to give you a harsh dose of reality, because true financial security requires standing in your truth. And the truth is this: if you think you can simply roll all your money into a bank retirement account and coast through your golden years, you are making a potentially catastrophic financial mistake. Let's talk about the fear driving this decision. The fear is losing money. It is the fear that the market will tank right when you need to start taking withdrawals, forcing you to sell your stocks at a loss. I get it. That fear is completely valid. But what you fail to see is that by running away from market risk, you are running straight into a far more dangerous, silent killer of wealth. And that killer is inflation. When you put your money into a retirement bank account, whether it's a basic savings IRA or a series of bank CDs, what are you earning? You might be earning 2, 3, maybe 4% if interest rates are high. But after you factor in the rising cost of healthcare, food, energy, and housing, your purchasing power is actually shrinking every single year. If your money is earning 3% at the bank, but the real cost of the things you need to survive is going up by 4 or 5%, you aren't protecting your money. You are safely, guaranteed, losing money every single day. You are outliving your money, and that is the absolute ultimate retirement nightmare. So, let's answer the core question: can you retire using a retirement bank? The answer is a conditional yes, but absolutely not the way you think. A retirement bank account is not a standalone solution for your entire nest egg. It is a tool. It is a single component of a much larger, comprehensive, and protective retirement strategy. Think about where bank retirement products actually belong. They belong in the cash and safety bucket of your portfolio. They are there to provide absolute guarantees for the money you need to live on in the immediate future. Because deposits in a bank retirement account are insured up to $250,000 per participant. That means the principal is safe from market fluctuations. If you need cash next month or next year to pay your property taxes, your insurance premiums, or your grocery bills, that money should absolutely be safe and secure in a liquid, guaranteed account. But what about the money you don't need for 5, 10, or 15 years? If you leave that money sitting in a bank account earning minimal interest, you are committing financial suicide. To survive a 30-year retirement, you must have a portion of your money growing faster than the rate of inflation. And the only way to achieve that growth is by keeping a significant piece of your portfolio invested in high-quality, dividend-paying stocks, mutual funds, or exchange-traded funds through an investment brokerage account. You need to understand the difference between being safe and being secure. Safety is an illusion if it causes you to run out of money when you are 85 years old. True security comes from having a plan that balances preservation with growth. Here is your actionable takeaway, and I want you to listen to me very carefully. You need to implement a strategy called the 3-bucket approach to manage your retirement income. Bucket number 1 is your income bucket. This is where your retirement bank account finally shines. In this bucket, you keep 3 to 5 years' worth of your living expenses, the money you need over and above your Social Security or pension. You keep this money in FDIC-insured bank IRAs, high-yield savings accounts, or short-term CDs. Why? Because if the stock market crashes tomorrow, you don't care. Your next 5 years of income are entirely locked down, safe, and unaffected by Wall Street. You have bought yourself peace of mind. Bucket number 2 is your growth and income bucket. This is for the money you will need in years 6 through 10. This money can be invested in more conservative balanced funds, high-quality corporate bonds, or fixed annuities that offer a blend of modest growth and protection. Bucket number 3 is your long-term growth bucket. This is the money you won't touch for at least 10 years. This money must stay invested in equities and growth-oriented index funds. Because it has a 10-year runway, it has plenty of time to recover from any market downturns, and it will provide the heavy-hitting growth you need to outpace inflation and replenish bucket number 1 as the years go by. Do not allow your fear to dictate your financial future. Do not look for an easy way out by handing all your money to a bank just because you want to stop worrying. You have worked too hard, for too many years, to let inflation quietly steal your retirement dream. Be strong, be smart, use the bank for what it's good for, short-term safety, and keep the rest of your money working hard for your future. You can do this.